Welcome, everyone, to today's Boss Economics World, your one-stop source for the latest from the world of finance, focusing sharply on bad economic management that continues to dig us deeper into this economic swamp. Now, in today's episode, we have a lot to unpack. Grab your popcorn, because the volatility we're seeing is the culmination of decades-long mistakes, disrupted further by the recent political ambitions of the U.S. government under the incoming Trump administration. You're probably wondering what's going on in Washington's monetary world where the Federal Reserve plays puppeteer with our lives, and here comes Jerome Powell, whose spokesperson like gloss gives us the feeling everything is under control. But is it? Anyone keeping up knows the economy is a bubble of contradictions, and our dear Fed Chair Powell is caught right in the middle of the storm. Let's venture right into the economic recklessness that we're all paying for, starting with the Fed's interest rate cuts, the so-called neutral rate, and its actual impact on the economy. Behind the complex financial jargon are policies running us down a path towards probable disaster. Jerome Powell is out here talking about caution in cutting rates. Yes, you heard that right, caution. But why are we worried about too much caution when the economy is supposedly in remarkably good shape? Powell's statement on seeking neutrality stirred analyst speculations across Wall Street, eagerly anticipating rate adjustments in December. We can afford to be a little more cautious as we try to find neutral, Powell says, as if we're somehow teetering on the edge of economic diplomacy, not disaster. But here's what's ironic: while market data floats headlines about inflation tensions receding and the job market recovering, the real economy, the one you and I live in, tells a different story. Home prices soaring. Student debt levels through the roof. Wage stagnation. Yawn. These are all critical issues continuously buried under optimistic Fed forecasts and rhetoric of mild inflationary pressures, while Washington gleefully points at its so-called fiscal conservatism among roaring deficits. The banking honchos obviously love something about Powell's tune, rate cuts. The financial market anticipates this like junkies waiting for the next hit, and who wouldn't? After all, every rate cut means more king-sized bonuses for those hedge fund managers and Wall Street bankers. These folks aren't surviving paycheck to paycheck. But what about for average Americans like you and me? Priya Mishra, a well-known portfolio manager at J.P. Morgan Asset Management, stated that Powell was keeping a December rate cut on the table, and analysts suggest it might be one more quarter-point cut. So, another token nibble at interest rates? Great news if you're heavily leveraged in debt, perhaps, but this band-aid solution does little to address structural economic fragility. We're talking about glossing over fundamental issues that the U.S. economy grapples with, while the Fed continues fiddling on to keep an image of control. The incoming Trump administration and its rumored interest in appointing a shadow Fed chair even before Powell's term ends is a chilling reminder of how political maneuvering can unravel any semblance of institutional independence. Treasury nominee Scott Bessent has already floated the idea publicly, a clear shot across the bow aimed at Powell's leadership. Think about the consequences of such a move. The confidence of the financial markets, which is already dangling by a thread, could be further shaken. Remember, folks, markets don't just respond to policy, they react to confidence. The loss of trust in the central bank's independence, compounded by political leadership riddled with conflicting interests, could deal a severe blow to both domestic and international perceptions of the U.S. economy's stability. Historically, any time political pressure undermines central bank independence, inflation tends to spike. And I hate to remind policymakers, but the inflation beast is already stirring, despite the Fed's preferred measure showing us numbers neatly under control. Once political pressure comes into play, fiscal discipline goes out the window, leaving central bankers like Powell essentially toothless in their efforts to rein in rising prices without igniting economic collapse. A prime example, Powell insists, as with most Fed chairs before him, that inflation, though not quite where it needs to be, has definitively cooled off. This rhetoric hardly matches reality. Who are we kidding? Headline inflation might sound subdued, but for the average family, groceries are pricier, rent is through the roof, and the notion of living expenses as these massive corporations boost their profits implies that the cost of living is anything but tamed. The illusion of lower inflation continues to mask the stark disparities the average American battles daily. Let's bring in some cold, hard figures to support this. The Fed's preferred measure of inflation, the Personal Consumption Expenditures, PCE, price index, has been hovering at around 4.3% for 2023, far above the 2% target mentioned endlessly by Powell. Meanwhile, core inflation, which excludes volatile food and energy prices, might give a rosier picture, yet Americans' household budgets are being eaten alive by galloping food price inflation that averaged over 5.1% in 2023. So someone remind me, how exactly is inflation on a leash? The psychological narrative circling through our media is that low inflation equals a healthy economy. But, when inflation is underreported, the everyday struggles of working-class Americans grow. When we factor in the real-life data of housing, education, and healthcare, gasping for breakthroughs, inflation feels far closer to 7-8%. Now, let's be real here, why is so much of this talk centered around manipulating interest rates? It's because our economy trains Wall Street to gorge on cheap capital. Cheap borrowing costs give banks and corporations the fuel they need to float financial assets while real investments, those that create actual jobs and real wages, take the back seat. And we've been stuck in a cycle that pushes money into inefficient sectors of the economy over real sectors. Fixing the economy shouldn't mean inflating financial asset bubbles. It's the same old story of paper wealth, inflated markets, and, in the end, bust cycles that crush everyday Americans underfoot. As the December 17, 18 meeting of policymakers looms ominously on the horizon, Jerome Powell will no doubt decide to maintain this precarious balancing act. He might move forward with another rate cut, but remember folks, these cuts are mere sugar pills, the real disease is structural. Compounding this, the lack of a clear and coordinated fiscal policy from the incoming administration only adds petrol to the fire. Let's not forget, lowering rates at this stage could blow more air into the already puffed-up stock market balloon, with the S&P 500 showing year-over-year growth of nearly 16% as of November 2023. Some analysts are openly comparing current conditions to the conditions leading up to the financial crisis of 2008. Yet here we are, encouraged by small cuts and broad smiles from the top ranks, while the broader economy is screaming for smarter, long-term fiscal solutions. The takeaway here, dear audience, is that the Fed under Powell is walking a fine line between political pressure and so-called prudence. But as cautious as the chair pretends to be, we're still racing quickly down a path of instability. Add to this the unsettling lack of strategic clarity from the Treasury side of Washington, and what do we get? A perfect storm is brewing here, one that threatens to hit average Americans the hardest. It's becoming clearer each day that neither lowering rates nor sitting on them will fix the fundamental cracks in our economic model. Wage growth continues to stagnate, inflation erodes the purchasing power of everyone except the wealthy, and the American dream drifts even further out of reach. Meanwhile, Powell placates Wall Street with dangerously short-sighted policies, all under the guise of managing stability. Our economy needs bold, comprehensive reforms, not just a knee-jerk reaction to smooth over stock market volatility. The sooner individuals in power wake up to this actuality, the sooner we can try to avert a full-scale crisis.